Welcome back, everybody, to part 2 of this short VXX trading series. So hopefully you've had a chance to check out part 1 already. I'll leave a link up here. In that video, we used our knowledge of how the VXX works and we estimated its future price 8 months from now. We know the VXX derives its price based on the decay factor of the VIX futures that it holds, essentially what's called the VX30 to VIX roll yield. We can use 20 years of historical data to calculate its long-term decay factor, which is minus 2.49% per day or minus 5.1% per month if that's easier to remember. And then from there, we just map out the expiration date for the options trades we're about to take today. And we're expecting the VXX to be trading at a price of around $25 on January 19th, 2024, which is 8 months from now. With our target number and expiration date, today we can execute all 5 live short volatility trades and we can see which method has the best risk-reward ratio. So smash that like button for me and let's dive into the Thinkorswim platform. As I showed before, obviously these volatility ETPs decay long-term. In fact, the VXX is down 99.9% since it launched, so clearly we want to be on the short volatility side. I guess the real question is how? There's many different ways to represent a short volatility trade. Some of them are quite safe, others are extremely risky. Basically depends on your own level of risk tolerance, but I'm going to open 5 different ones, so we have a good mix here. So here's the VXX over the last 2 years, and aside from this volatility spike here, where it basically doubled, it's mostly doing its thing, basically decaying downwards over time. It's an insurance product. Obviously, it decays long-term, right? Markets wouldn't make any sense if insurance products had a net positive long-term return, so this isn't overly surprising. Now, the other piece of information here, remember, I'm setting the target date for these trades right there on the 19th of January 2024, 241 days to expiration. I want to give these trades time to develop so we can compare some differences in follow-up videos. And I will mention too, we're going to try to scale these roughly to the same size whenever possible. So let's get started. The first trade we're going to open is just your basic run-of-the-mill put option, and that's going to look like this. This one is for a 27 strike. And remember, since we're doing 5 trades here, I do have to make sure we're using different strikes for each of them. I can't double up on any of these. But looking at this 27 strike put option, this is what they look like. The break even is here, the current price is right here, and the pink line is the daily profit curve. So if we are right and the VXX does decay downward towards here, if it happens quick enough, we can make some money. This is a short volatility trade. So if we go to the trade tab to actually execute this, we find the 19th of January, 241 days, and we can scroll down to that 27 strike and we can buy to open a single long put option. Now, like I said, I'm going to try to scale these, and the number I'm looking for is about $1,000 of risk for each of them. Long put options are open for a debit, so we want to pay as little as possible, and we just divide 1,000 by the premium paid, which is right now looking to be about $370 at the mid price. So we can probably get 3 of these. It's not going to be exactly 1,000, but we'll try our best. Now, to actually execute this is where I would use what I call the 30-second rule. With options trading, we use limit orders only, never market orders, and we're always trying to get something close to the mid. So if the mid is 370 and I'm actually trying to pay less, I could start my trade at 365 and I could actually see if I get this. So I can go up here into the monitor tab. You can see I'm trying for 365. It looks like about 375, maybe 380. So I'm not going to get this, but I would wait 30 seconds just in case. These are computers. It happens quick. You don't have to wait all day, but I'd wait 30 seconds. And then if I don't get it, I would just adjust this one of the smallest increments. In this case, it's 5 cents. And I would just try again. And I would keep doing this. You wait your 30 seconds and keep going. It typically won't take more than 2 or 3 tries, but this is how you ensure you get the best fill prices. So because this is a video, I am going to speed things up a little bit. Let me just go ahead and execute this and get it done. So there we go. I actually got 380 for that trade, and this is what it looks like. We've got a long put option open for the VXX. Now, the second trade we're going to take is called a long vertical put spread. For this one, remember, we do have to do different strikes here, so I'm doing the 29-24, and it looks like this. So we can see directionally, this is the same bias. Here's the daily profit curve, the pink line, and again, if the VXX trends towards the 25 range, which is what we're expecting, then we are going to make some money. It is short volatility. In the case of verticals though, the maximum gain and the maximum loss are both capped, and in this case they are roughly even. It's a different risk reward profile. Now the one thing I will draw attention to, because this is going to be important in follow-up videos, a long put vertical option, you can see it is using both a long strike and a short strike in the same spread. That's different than a straight up put option, which is only a long option. This vertical spread is going to have a much lower Vega factor. Again, we will get into that in follow-ups, but just remember that part. Vertical put spreads are different than long put options. So again, if we want to execute this one, we are just doing a 29.24, so I can just buy to open a vertical put. The 29 is going to be correct. I can just adjust the 24. Now, as far as sizing goes, I think I could probably get 4 contracts and that will take it to roughly the 1,000. And then at this point, again, I would do my 30-second rule. Now, in this case, I'm not going to do that, so let me just go ahead and execute this trade for you. So that trade is done now. Again, we can highlight that one. It is right here and it is now live. So the break-even price for this one would be right there. For this third trade, we're actually going to be doing one that you probably don't use very often. It's called a butterfly spread. It looks like this. People don't often associate these with short volatility trades, but I use these a lot on things like the VXX and the UVXY. I think they're an excellent way to represent a short volatility trade. Here's the price right here. Because we know there's going to be a decay factor more than likely, we're actually trying to target something that lands in this pretty generous range here, from about 20 to 30. Another thing of note with the butterfly, if you notice, look at how little capital I'm risking compared to how much capital I can actually make. If I get my prediction of around $25 correct, this trade can make many multiples more than I'm risking. And if I'm wrong, of course, you just lose the capital over here. Don't overlook the butterfly spread as a method of targeted volatility trading. So to actually execute the butterfly, this is what is called a 20, 25, 30 butterfly. So you just go to the 25, you buy to open a butterfly. And then I just have to adjust the strikes to make sure it's the right one. So I'm going to do the 20 and the 30. Now, because this is a debit spread, again, we just take our $1,000, which is our intended maximum loss, and we divide by the premium paid. Now, we're doing a strike that's pretty far out into the future, so it's not surprising that the mid and the natural are pretty wide. It's probably not going to display a very accurate number. This just comes with experience. I can get a pretty decent idea of where this thing is going to execute. We would go ahead and try our 30-second rule. And there we go. This is what the butterfly option looks like. So the initial break even is right there. Got this really nice big profit range here at the 25, much larger than what we're risking. And again, this is a short volatility trade. We will see how it compares to the other ones. So for those first 3 trades, they are all what's called defined risk. So the maximum loss is capped. I scaled them all to $1,000. So no matter what happens going forward, I know I can't lose more than that. So they all have the same general risk. The 4th trade is a short straddle, and fair warning, it is an unlimited loss trade. I almost never use these, but I do want to have something in that category of naked options. Again, we have to use a different strike than all of the other ones. So right now I'm using a 26 strike. The straddle looks like this. It looks like a very big profit range. Now, unfortunately, I can't scale this one to $1,000. This is an unlimited loss trade. But I will point out that just one single contract of this straddle is going to use up over $5,000 of margin. So you could make a case that this trade is already about 5 times larger than the other ones. This is as small as I can get it. In future follow-up videos, we will just have to divide that by a certain factor. Remember that naked options are very capital intensive. A lot of people mistakenly think that the biggest problem with naked options is the risk. And yeah, sure, it's a massive problem, and a lot of people out there end up blowing up their account when they use them. But another risk people often overlook is just the opportunity cost of using an option structure that is so capital inefficient. You're tying up massive amounts of money to just try to make small profits. The old picking up pennies in front of the steamroller analogy. With naked straddles, naked calls, for example, even if you don't blow up your account, you'll still make way less profit long term than some of the other defined risk strategies. Today, though, we do want to be comparing several different short volatility methods, so we will include this one as well. Again, I'll go over here to the trade tab, go ahead and find the 26, and now in this case, we are selling one single straddle. This is a credit spread, so we want to bring in as much premium as possible. Something closer to the mid over here if we can. Let me get this trade done. And there we go. We've got a straddle opened up. We can check out what that looks like here. Cancel that one. This is our straddle. So again, follow-up videos will be much more detailed, but you can see what's going on here. The price is right here today. Of course, we want the VXX to bleed down into our profit range, but don't forget, this is an unlimited loss trade. The losses here can pile up very quickly. That's why we're not going to be confused by this trade. A lot of people will look at this and go, wow, there's a huge profit range there. Well, yes, but it's 5 times as large as the other trades, and look at how big the losses can be. This is not a very good risk-reward ratio at all. I don't mean to be too condescending, we all start at the same place, but a trade like this is kind of a rookie trap. A lot of very new traders look at this and they think this is a good trade to take. What you find long-term is that the risk-reward ratio is pretty terrible. As you gain more experience, you will quickly move away from undefined risk options. Now, for the last trade we need to take, I think it'll be a really good baseline if we just hold the ETP itself. So in this case, if we just look at a straight up short VXX position, it would look like this. This is not options. This is just short the ETF. Direct short vol exposure. Unlimited loss upside. If we take the $1,000 and we just divide by what the ETF is trading at, which is roughly 36, give or take, we could get about 27 of these open. Now there's a problem because I don't ever short the volatility ETPs directly. There's big fees involved. They can be hard to borrow. You can have your shares called away on you at any time, so you're not really in control of your own trade. And of course, they are unlimited loss, which is never a good way to trade long term. So instead of shorting the VXX directly, we are going to buy the SVIX, which is a 1x inverse volatility product. On a daily rebalance basis, it's basically the same as short VXX, but as a long position, so it solves all of those other problems. I'll keep this short VXX trade highlighted and tossed down here, because when we're comparing all these trades, it'll be very easy to click through them all. But for the official position, I am going to go long the SVIX. So if we take our $1,000 and we divide by the price of 20.07, we can get about 49 shares of this ETF. Again, trying to get something closer to the mid. Let's fire this off and see. There it is. And now we actually have all 5 of our trades open. They're all down here. We're using different strike prices for all of them. And now we can make some comparisons between them. We have a long 27 strike put option that looks like this. Break even right there with profit loss on each side. We've got a 29-24 long vertical put spread. Looks like this. Again, break even. Profit on both sides of it. We've got this pretty interesting 20, 25, 30 butterfly option, which is always a personal favorite of mine. Max profit is right there at our predicted price of $25, and then losses on either side. Of course, this side isn't very likely, but if the VXX turns out not to decay, then of course over here there are some losses. The next one, even though it's incredibly unadvisable, we do have that naked short straddle. Now, reminder for this one, it does require over $5,000 of margin, so we'll probably cut this into a fifth. Even for a tiny trade like this, I do feel uneasy doing these. Part of me is actually hoping the market does crash just so I can illustrate why this is such a bad idea to do. We will see. And then the last one, like I said, we will just leave this one open. I will lock that price. And this is just a direct short VXX position. For tracking live, I will use the long SVIX position that we opened. 5 trades, 5 different methods of shorting volatility. Let's see how these go. Question of the day. Which short volatility method do you use the most in your own trading? And since this is only day 1 of this long-term test, make sure you comment down below. Which one of those trades I just opened do you think is going to make the most money? And then which one is going to be the most problematic? In the next video, we'll dive into all the advantages and disadvantages of each of those 5 trades. And remember, I do a regular live podcast as well, so we can always cover these in real time. So make sure you tune into my podcast. This should be a very interesting test. See you next time. So for an extensive volatility metrics dashboard updated daily, and to see all of the live trades for our tactical rotation and option strategies, click this link right here and claim your free trial to the VTS community. You're always welcome to join us anytime. See you next time.